Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 350 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. Let's jump in. Today, I'm Aaron Kramer. We're here with the one and only Nick Whitaker. We're going to give you a few good topics. We got some news headlines, and as always, we'll start with the review of the month-to-date and year-to-date performance on the major indices that investors track, the status from Y-Charts, and as of the market close on May 13th. Nick, I'll let you run through it.
Alrighty, good to be here as always. And the pricing will start with the S&P 500. It's up 3.3% month to date and 8.7% year to date. The Dow Jones is up 0.1% month to date and 3.4% year to date. The Nasdaq is up 6.1% month to date and 13.6% year to date. The iShares Russell 2000 ETF, think small caps, is up 1.7% month to date and 14.8% year to date. The Vanguard FTSE All World ex-US Index is up 2.5% month to date and 12.8% year to date. The Treasury market, the 3-month Treasury rate is sitting at 3.690%. The 2-year Treasury rate is sitting at 3.980%, and the 10-year Treasury rate is sitting at 4.46%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Interesting times in the market. We've had quite the bounce, quite the performance,
the melt up the last few weeks.
Yes, melt up is a new favorite phrase in the market. You're going to hear some of that if you haven't already. We'll actually get into a little bit of that later with some of our research pieces. Jumping into big headlines and current events, aside from the typical day-to-day Iran news, just checking in there, the market's continuing to bet on a solution prior to the U.S. economy seeing too much economic pain. I'll say it like that. You know, there's obviously been a little bit with higher gas prices, but the market's still betting on a solution. In some of the specific news, there's been some pretty big economic data, and there will continue to be big economic data in light of the Iran conflict. On Friday, April 8th, there was a jobs report. The jobs report was was good, not great.
Yep.
115K increase in non-farm payrolls. Unemployment rate was 4.3. Average hourly earnings growth was weaker than expected, and I think that was probably one of the sticking points that we saw some research percolate there, and we're actually going to discuss that a little later.
So you got a good topic on that.
Mm-hmm. On Tuesday, May 12th, CPI came out. The CPI print was not as good, but I think where the market is it maybe was not as bad as feared. CPI was up 3.8% year over year versus 3.3% in March. That's the total number. The core number being excluding food and energy, was up 2.8% year over year versus 2.6% in March. And I think that 2.8 was the market saying, well, at least it was only 2.8.
Yeah, it could honestly be worse. Right. So we'll talk about that more here soon.
We also have a piece on that as well. I think you have something there. And then lastly, Wednesday, May 13th, which was yesterday, PPI came out. That's the Producers Price Index. So
wholesale, right?
Yeah, I think wholesale prices for the companies that are bringing in goods. So the Producer Price Index for final demand was up 6.0% year over year versus 4.3% in March. The core PPI, again excluding food and energy, was up 5.2% versus 4.0% in March. And the key takeaway here, and the piece that I think the market was looking at, was that the surge in PPI in April was not exclusively energy related. Yes, there was a big piece that's energy related, but the 5.2 versus the 4.0 tells you that that's a decent jump.
Yeah, it is.
In a month over month. So the report really bellows that a rate hike. It really bellows for a rate hike more than it does a rate cut. Now,
yeah.
I don't think the market's pricing in a rate hike, but we're certainly not going to see a rate cut anytime soon.
I would agree. Yeah, I think the last time I did the podcast was a few weeks ago at this point, but I showed kind of a chart of what the futures market on rates was thinking, and it had shifted from the chance for a rate hike or rates staying the same to basically rates staying the same kind of throughout the rest of this year. So that would be my base case, unless inflation comes way down for some reason, that I don't think rates are going to move much this year, which is probably the right decision by the Fed.
I think last I looked at it, it's like 70% of the market thinks no change, and then the remaining is kind of split between a rate hike and a rate cut. So we're really, I'd say, majority thinking
stay the same.
Right. And I think I checked that yesterday or Tuesday, so that's pretty recent.
If listeners are curious, FedWatch on CME, Chicago Mercantile Exchange, will kind of show you what the futures for rates are. You can look out different, kind of timelines, 6 months, 12 months, all that good stuff.
Yeah, that's the tool we really like using. So encourage listeners who want to be in the know to check that out. Jumping into tweets, articles, and research from this week, I actually have 4, so I have an extra for listeners. I don't know if that's cheating, but
hey, there's just so much good stuff out there.
And my first one's pretty quick. I just wanted to show a chart of sector performance through 2026. This data is from YCharts, and it's just some proprietary charting and data that we use. And it's really just looking at a period analysis. So if you look at a chart of the S&P, you'll notice that the dates are purposefully looking at periods. So we're looking from the end of last year through March 30th, which is the downtrend that we saw. It was kind of like the bottom was March 30th. And then the 30th to the 8th, the reason I picked that period is there's kind of a gap up where the market jumped up there. And that was really the market repricing the Iran conflict and saying, okay, it's going to be over quicker.
Yeah, it was kind of that quicker V-shaped recovery where the market was down and jumped right back up quickly to get kind of back to even.
Exactly. And then and from like April 8th, there was like a week where the market was just kind of moving nowhere,
sideways,
really just like moving sideways a little bit. And then we saw what we saw in the back half of April and really into the beginning of May here. And so I've broken the sector performance down by these 3 periods just so listeners can see. Obviously, through March 30th, very much a defensive trade, and the energy trade was on there. Again, that's the Iran conflict, and the Iran conflict, I think the official start date was February 28th.
Yeah.
So there's some context there for you. And then that second period, you can really see, okay, the whole market was just readjusting, right?
Kind of as the market bottoms, I'm going to use air quotes. I don't know when it officially bottomed, but
which was 30th.
Okay.
Was kind of the official bottom of this little pullback here, which is around 10% pullback. But that second period is kind of nice because you can see, okay, the whole market kind of had a little bit of a rebalance. You have some of the growthy areas leading the way. Obviously the consumer defensive and the utilities weren't as strong, which makes sense because they were stronger in the previous period.
Yep.
And then energy had a little bit of a reversion. Again, you would kind of expect that.
Yeah, you're kind of seeing that rotation out of defensive into more, risk on areas of the market, right?
Exactly.
That's exactly what you would expect to see.
Yeah, and you would expect the energy to kind of, especially if the market's saying, hey, we're going to price in the Iran conflict as seeing a quicker solution, you would expect energy to kind of pull back a little bit. So that's what we saw in that week where the market kind of readjusted its expectations. And then this is the interesting part, and this is really the reason I wanted to show this chart and talk about it, was from April 8th to May 12th. You can see the sector performance really led predominantly by technology, up almost 24%, 23.7%. So a lot of that, I think, was investors going to growth and kind of buying ahead of earnings, and then a little bit of AI, fever, if you want to call it, or
It
enthusiasm.
could even be Wall Street, may have been underallocated the last few years to technology and AI, and that was their opportunity to kind of get in. And it definitely looks like it correlates hand in hand with earnings, kind of buy the rumor, sell the news, but they haven't sold yet.
They haven't sold, yeah.
So, and I know you've got another piece on earnings, so I mean, it makes sense why they haven't, right?
Right.
So no, that's a really interesting piece of data. I like that. It kind of shows what the trend the market has been across the board through the start of this year. So really useful.
Yep. So that can take us into my next piece, which is 2026 earnings guidance. And this is a piece from Charlie Bilello Research. It was on May 7th, so about a week old at this point, but still very
relevant
useful.
For sure.
And the piece that really jumped out to me that I just he had a big, long research piece, as he always does, and they're great. And I just wanted to take one line from it, which is, for the full year 2026 earnings are now expected to grow 22%, a significant uptick from expectations only a month ago of 18%. I think that's a contributing factor to why we haven't seen the buy the rumor, sell the news is corporate earnings. And I know
they're
talked
backing
about
up those premium valuations, right?
Exactly. Corporate earnings have been very strong, and then the guidance has come out, and then the guidance has been very strong. And so I think, we had that big move in throughout April, and obviously there were some earnings that were coming out in early and mid-April, but the tech earnings were not coming out until later in the month, which is pretty typical. And so you saw a lot of that price action ahead of some of those earnings. Now, obviously, that's going to be pockets. Certain stocks are going to jump and whatnot. But I think the earnings really backed up some of that buying, which is why we have not seen that sell
reversion to
sell
the mean, or
kind
of the.
Not saying that we can't see it throughout the end of May or sometime this summer. I think that's a very decent possibility that we have, a little bit of a chop down at some point. The market just taking a breather.
I would
some
fully
profits.
expect that at some point, as we get through spring and into summer here. That's super useful. It makes sense why the market hasn't kind of slowed down yet, especially in those kind of higher beta, growthier tech names, is because their earnings have been phenomenal. They've been backing up all of those valuations that they have. So it's really interesting. We kind of look at what the PE ratio should be on a stock, looking at history. I know Matt talks about this all the time. Should be somewhere, I don't know, where it's 16 to 18 times multiple, and they're hovering around that 20, 22, 23. But if companies are growing at 22% on average, and there's going to be some way higher than that, I mean, it makes sense, right? You look at forward PE versus historical, I can see why those valuations are so growthy.
Yeah, and I think I've seen. I'll try not to get sidetracked on the PE ratios. I'm not going to get sidetracked on the PE ratios. Actually, I'm going to choose not to.
It's a hot,
I want to,
hot
but
button item.
Yeah, I'll leave it alone for now. So, my next piece is kind of taking a little bit of a deeper dive on the Q1 earnings and just doing a quick recap. This is an ex post from Mike Zaccardi. This is actually on Tuesday, so this is very fresh. He says, of the 449 companies that have reported so far, which is 90% of the S&P 500, overall 86% are beating estimates.
It's phenomenal.
And those that beat are beating by a median of 6%.
Even better.
The growth rate, the blended growth rate, is 28.1% on EPS growth. So that's a big growth rate.
It is massive.
And he has a chart here which shows Q1 2026. This is year-over-year earnings growth for the first quarter, and the columns. I'm gonna break down the columns because they are a little bit kind of confusing if you're just glancing at it. I actually had to look at it a little closer because I was like, this doesn't make sense. The first column is actual companies that have reported. So they've reported their past earnings. The second column is estimates on the remaining companies. Again, remaining 10%.
That
So
still
some of
haven't
those could
reported
be
yet.
companies that are expecting really good. Some of them could be expecting really bad, but it's kind of a smaller data set, which is why you're seeing some like kind of volatility. And like if you look at consumer services, for example, you see like the minus 45. What's going on here?
It's just
That's
a few
just
names.
a few names that are not expected to have this good of growth.
Got it.
So that's a very important distinction between those two columns.
Yeah, so I think that blend of actual and estimates is what we should probably be looking at here, right?
Exactly. I think look at the last column there, which is the highlighted blue, which gives you a good sense of how much growth there is in the market, particularly in tech and consumer discretionary and consumer services. If you go back and think about, okay, tech growing at 50%, comm services growing at 49.4%. Okay, comm services, that's, some very tech-like names as
Sure,
well.
yeah.
They separated those out years ago. And consumer discretionary and basic materials. The basic materials, that's going to be related to the energy trade, right, with the Iran conflict. And the consumer discretionary, 40% is actually really good, especially considering how the sector has performed year to date. If you go back
That's
and
great.
think about those sector rotations that we showed at the beginning, consumer discretionary has not performed as well as tech, but the earnings are pretty good. And I think there's a reason
Very
for
good.
that.
Yeah. It's interesting. And even with, slightly higher inflation over the last several years, I mean, consumer discretionary holding up and growing shows that people are spending, right? So I think that's a good sign for the overall market.
Yeah, I think it's
awesome.
I think it's a great sign. I think kind of going into my next piece, the reason that there might be that little bit of divergence between, okay, the consumer discretionary earnings look, on paper, they look really good. The performance of the stocks, it's good, of course. It's not driving the market as much as we saw tech driving the
Sure.
market over the past month and a half. And I think the reason on that is what we talked about earlier with the average hourly earnings coming out in the CPI print. And this leads me to my last piece, which is checking in on the consumer. This is from briefing.com. They call it the big picture. This was released on the 8th of May. And it's something just I think investors may want to keep an eye on and just be aware, which is real earnings, which are adjusted for inflation, are decelerating. There's a chart that we'll show, and in the chart you can note the correlation to the Iran conflict, which started on 2/28, and you can see really the moment that started, that's eating into the discretionary spending ability of the consumer. Again, we talked about it, the market's hopeful that the Iran war will end soon, and that this buffer for consumer spending will resume higher once energy and food costs kind of find that equilibrium. The concern and the area that we and all the market and investors are going to be watching is if this trend remains or persists, spending habits are going to change, which is bad for the economy and will eventually flow into corporate earnings, even though they're very strong now. Just a friendly reminder that the consumer spending makes up about two-thirds is typically what you see, anywhere from 65 to 70% of U.S. GDP. So if we start to see this trend really persist from here or go lower, then I think there will be some pain there, and I think
maybe a little bit of a headwind for the market.
Exactly, and so I think that's something that the market's going to be watching, and we've talked about it, I'm sure, in the past, and there's no shortage of talking heads in the market that are talking about the Iran conflict, and it simply breaks down to the longer the conflict drags out,
the longer oil prices are elevated, gas prices, it's a tax on the everyday person, right?
Exactly, which is the worse it's going to be for the consumer.
So, question I have for you on this chart, is this just all consumers as one? That's my question. I would imagine so.
Yeah, it's the basket of CPI. So it's just a breakdown of a basket of goods and looking at the year-over-year change
for the average median earnings for an American, right?
Yes.
Okay.
U.S. data. Yeah.
Perfect.
And the deflated, why it says deflated is because they're taking out inflation.
Yeah, it's basically real wage
it's
growth.
real,
So
yeah.
if wages grew at 4%, but inflation was 3%, really wages only grew at 1%, right?
Right.
So
Exactly.
super
So-
useful. It's interesting. I'm curious because this is an average of the entire U.S. I know a bulk of the spending is done by kind of that upper 10% consumer. I'm guessing, this is my personal opinion, I could be wrong, but I think this is useful, but I think that 10% that aren't as affected by $4, $5 gas prices, they do the bulk of the spending. I know Matt says this all the time, so I tend to agree that, could it be a slight headwind? Yes, but as long as that 10% kind of upper consumer is still spending, I think that's where it really matters.
Yeah.
So interesting, very, very useful data though. I think it goes to show you how impactful oil prices are, because it takes oil and fuel and energy to do everything, whether it's, building a laptop to getting your groceries delivered, or, it literally impacts everything,
to
right?
making cereal.
So, I mean, it's exactly right. So you can see, what is it, February 28th, which is shortly after the Iran conflict started, that straight drop.
Straight
and then
down. Yeah.
It looks like as we've gotten some relief from the Iran conflict and oil prices have somewhat stabilized, it's starting to trend back up.
A little blip
so
up.
hopefully this kind of normalizes and get back toward that, 1% and above year-over-year growth, I think would be welcoming and comforting for the market.
It's very healthy. I mean, when you have this chart up in the 1%, that's your discretionary income.
Absolutely.
That's the simple way to think about it. And so for the average consumer, you want to see this chart a little higher. And it's done pretty well over the past couple of years. But that's a contributing factor to why the U.S. economy has held up.
And inflation's been down versus the previous few years, right?
Mm-hmm.
So it's going to take wages some time to catch up, honestly. So awesome chart. It's a good one.
Mm-hmm.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
I think that takes us right into your next.
Right into
piece.
mine. Yep,
Yeah.
CPI. So that's perfect. So I got a X post from Heather Long on Tuesday, which is the 12th of this week. So it says, Justin, U.S. inflation jumped to 3.8% year over year. We already know this. Inflation rose 0.6% in the month of April due to soaring gas prices that accounted for over 40% of the increase. Right. Mm-hmm. So rising shelter and food prices also pushed up inflation. Core inflation, which excludes food and energy, came in at 2.8%. Again, we already know that, but I think we saw that kind of downtrend in inflation since 2022. Really, it's obviously the Iran conflict. As soon as that's wrapped up and there's more certainty, I feel that inflation will normalize. Everything operates on a lag, so it's not going to be overnight that it could still trickle on for the next 4 or 6 months even. But I do think as this conflict hopefully wraps up shortly, inflation will normalize, and that might give the Fed a chance to start cutting maybe next year.
Yeah, I was about to say.
maybe. So, and the markets, it is always forward looking. So all of this data is pretty much priced in at this point.
Mm-hmm.
You know,
Absolutely.
I would say the market's priced in that a rate cut's not going to happen this year.
For sure.
So if it's looking out 12, 18 months, I think it knows that a rate cut's pretty unlikely at this point.
Yeah.
Curious on your opinion, if for some reason we did get a rate cut this year, what do you think the market reaction would be?
Oh, I think the market would love it.
Yeah.
The market would love it. I don't think we're gonna get it this year.
No,
just
I
think
really don't either, unfortunately.
when inflation goes up like this, and I think Matt talked about it last week, kind of breaking down the Fed between hawkish and dovish. So if you want to go back to last week, if you missed it, you could check out that section where he talks about that. There's just more hawks on the board.
For
and
sure,
so
as there
I
should
just-
be.
Yeah,
in my opinion.
yeah. I mean,
Yeah. So
the
I
data
know.
speaks for itself.
I knew
so.
that the new Fed chair that's I think starts tomorrow.
That sounds right.
He's much more dovish than the majority. But you know, obviously it's a committee. So
It's a committee.
It's
yeah,
not just him.
And Powell's staying on, so that's a fun story
Dynamic.
and wrinkle. That's
There's gonna be some tension on the committee for sure.
There's definitely going to be headlines about that. Who's actually running the Fed? I'm just waiting for it. And if we see a headline in the next 2 weeks about that, you heard it here first.
All right. I got another tweet, or excuse me, X post by Bespoke, also on the 12th. This says, after another day yesterday where the market index closed higher on negative breadth, there are now fewer than half the stocks in the S&P 500 above their 50-day moving averages, even though the index itself is up 7.8%. It's up a little over 8% now as of today. So I think it kind of goes to show with that first piece of research you showed that, you know, the market did pull back considerably kind of March and into early April. And really what's led the recovery is technology and consumer discretionary, basically.
Yeah.
So we've seen that area push these market cap weighted indices up higher, while a lot of these names are still kind of slowly stair-stepping higher. I think it's the trend of AI, in my opinion, is what's leading the market higher. And I don't see that going away anytime soon this year.
No.
You know, I think there's a pretty great opportunity cost for holding a boring healthcare name or, you know, an energy name now versus what's pushing the market higher. So not a recommendation for or against any of those sectors or areas, but this is not the most encouraging data, I would say. Generally, we want to see the whole market making new highs, but it could just be a period of year where, you know, tech and AI is in vogue. And I think that's going to be the case. And I think a lot of the reason earnings reports are looking good is because of the efficiencies of AI and technology. So, you know, it's kind of a double-edged sword that, you know, we want these areas to continue to run, but not seeing the overall market doing it as well is not as encouraging. So it's like a no man's land right now, in my opinion.
I agree. I think the market loves to see breadth. And we would love to see, you know, much higher breadth. But this is the environment that we're in. You know, this is just something to consider and make sure you're paying attention to.
It's kind of been the environment for a while now. You know, even looking at the last few years, you know, tech has pushed the market higher, and when it doesn't, the market's kind of flat.
Yeah. I mean, a lot of it gets back to the earnings growth that we talked about earlier, and you know, it's things we continue to watch, and it's not something that I'm, you know, terrified about or
I'm
super nervous.
Not a worry. I think honestly we could see this shift if we get a small pullback in technology. If you know, if it kind of normalizes, I could see it not being maybe a massive market pullback, but a pullback in some of those areas and a rotation into some of the more, let's say, undervalued areas of the market.
That's a great point where you could see you know, maybe a small pullback in the market, but it's going to be more of a general sector rotation where you see that
would be extremely healthy.
Yeah,
for the market.
I would, if that happens, I would love to see that. That would be a very bullish move, I think, in my opinion.
Absolutely.
So fingers crossed for that, I guess.
All right, I got one more here. This is next post by Ben Carlson, and he's got a chart measuring past melt ups. So his post here says the NASDAQ 100 now has higher returns over the past years than Japan in the 80s, the Dow in the roaring 20s, the S&P 500 in the 50s.
Yeah.
Still trails the 90s tech run, but it's close. He says, he has some hot questions here. Is this it? Is the melt up here? How much crazier could it get? So there's our melt up terms, right?
Yeah.
It was coming, and it's not. That's going to be the buzzword for the next several weeks here, in my opinion.
I saw it on my 3 pieces of research yesterday. Yeah.
So it's interesting. I'm not one to call peaks or tops or valleys. I think my personal opinion is tech and AI are still here for a little while. I think it's got some time to run before it's a true melt up or a peak. So, it's just what's in vogue, and NASDAQ's a AI tech heavy, it's basically a tech indices at this point.
Right.
Obviously there's some other names in there, but
and the NASDAQ 100 particularly has a ton of exposure to AI. I mean, they're the leaders of AI.
absolutely. So I don't know. What's your take?
I understand the comparisons, especially when you look at the price reactions. I am not there yet to say, okay, this is a melt up that's overextended. I think it's just a little different.
I think it's way different than the 90s because the earnings reports are backing it up. It's like the 90s, this is going to be a large generalization, but it was every software and web-based company that had no earnings yet that was running up 1,000%.
Yeah.
And you wonder why there's a bubble, right? So I don't think that's the environment that we're in. Are there pockets and pieces of overvalued names that aren't going to make it? Sure. But the big names that are moving the market are long-standing names that came out of the late 90s, right?
Right.
So I think it's too early to say that it's a melt up, in my opinion.
Yeah, I agree. I think one of the key differences is, and I think one of the key differences is if you look at the actual chip market and what's happening is the supply and demand dynamics are just a little out of whack right now, where there's so much demand for these chips and there's just not enough supply, and that's driving up the price of the RAM market,
the GPU market, the CPU market, all of the hardware that goes into this AI technology.
And particularly what we've seen in the past month, and some of the names that have really pushed technology higher are some of those cheaper memory chips. And they have had pretty astronomical performance. But again, it's tied to their earnings because they're selling these products at higher rates because they have so much demand. That
as demand starts to fizzle out, their earnings reports aren't going to look as good, right? So I think that would be more of a time where I would say, hey, if they're still at these elevated premium prices and their earnings aren't backing it up, I think that's more justification for calling a top, right?
And the issue with that is there's really no one out there is saying that demand is going to soften anytime soon. That's one piece. And
as long as the big tech companies are making these massive investments and spending trillions of dollars over the next several years, if CapEx continues to be what it is, demand's not going to go away.
So that's one piece is the demand. So the demand, no one's really seeing that going away. And the second piece is supply. The issue, and it's not like oil, right? Where we just pull more out of the ground.
They're not sitting on massive reserves either.
That's not how it works. And yes, they're building new facilities, but these facilities on average take 5 years to build, give or take, depending on how big they are, et cetera. So we can't build out supply that fast. And in the past, the semiconductor area has been known to be very volatile, very up and down because of the cycles of a lot of high demand and then demand falls off. And so these companies are pretty disciplined at this point to not build out too much supply because they've seen these cycles over the past 10, 15 years. And so there's some of that reluctance to, take on too much capital, build too much supply, because they need to keep their balance sheets clean and they're trying to do what's in the best interest of shareholders. So right now we're in this it's not an equilibrium. There's just way more demand than there is for supply, so much to the point where the industry is even changing some of their contracts to where in the past, a lot of the contracts for a semiconductor, if you're a big company, you go out and maybe the contract was like 30 days. But we're seeing contracts signed for a year and
Right. So they've got
years
locked in
out.
recurring revenue for a couple years.
Exactly. And so I think all of those dynamics that we just talked about is why it's different from some of these past areas. Is it's more fundamentally driven, and it is driving revenue, and it's real revenue. These people are buying a product that's going to be sold or used for efficiencies of their business. I mean, it is very real and tangible as opposed to the .com bubble. I'm not saying that there weren't companies that were making some money, but in general, the .com bubble, there was a lot of debt.
Absolutely.
And there are some companies in the AI trade that have a lot of debt. Yes, of course. But there's also a lot of earnings with it. And so in my opinion, the melt up it's easy to compare on a chart because of what we've seen in the past month, particularly with people pouring money into these smaller chips, smaller memory chips, that I think maybe the market underestimated how much they were going to be needed for AI to run effectively and how much extra memory that we need. But again, I think at some point that supply-demand dynamic will kind of equalize and smooth out.
Right?
And then the hope, at least from my perspective as an investor, I hope that we can understand that and kind of get a good read through on that so we can see in earnings. Because, yeah, I'm sure people will take profits from the AI trade at some point, whether that happens this year, next year, 2 years, et cetera. At some point, you'll kind of expect this to like level out, but I still think that the long-term trend is
higher,
up and to the right.
Sure.
So
love it. Great synopsis.
Yeah. So hopefully that helps listeners. And was that your last?
That was my last piece.
All right.
Any last thoughts for listeners?
No, I think that was a lot for people to think about. Getting in the weeds a little bit. But that was great. Do you have anything else?
Yeah. All I say is, invest for the long term. It's not a time to, in my opinion, to take speculative risks or, be overly conservative. Invest for your own risk tolerance, like always. Yeah. This is a multi-year, multi-decade investing strategy, not a get-rich-quick scheme here. Yeah. So I'll sign off. Thank you for listening to episode 350 of the Independent Advisors Podcast. Catch us next week on episode 351.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.